Good evening, everyone. Myself, Ashwati Nath NJ, Assistant Professor on Contract, Department of Commerce, University of Kerala. And today I am going to give a brief idea about partnership accounts, accounting for non-profit organization, uh, costing, the concept, elements, and classification, and unit costing. And we can start with the partnership accounts. So we know there are different types of business we can choose from when we are forming a company, and each with its own legal structure and rules. And typically, we have four main types of business, like sole proprietorship, partnership, limited liability companies, and corporation. So, a partnership is a kind of business where a formal agreement between two or more people is made who agree to be the co-owners. And actually, the partnership accounts or partnership firms are administered under the Indian Partnership Act 1932. And according to the law, the specific generated from the business under the supervision of all the members or behalf of other members. Actually, this is the definition given by the or according to the Indian Partnership Act 1932, and the definition itself, which clearly states all the features of features of a partnership firm. So we can see what are the major features of a partnership firm. So obviously, it's an agreement between partners. So in the definition and the meaning itself shows that it is an association of two or more individuals, and a partnership which is arises from an agreement or a contract. And all of you know the agreement may be in the form of oral or written, and if it is a written form, it is called agreement. So without an agreement, without a legal agreement, no partnership firm can formed. So there should be an agreement between partners. And the second feature, two or more persons should be there. So actually, in order to manifest a partnership, there should be at least two persons should be in the firm. So it states that the minimum number of members or minimum number of persons to form a partnership firm is two. And actually, there is a controversy regarding the maximum number of persons. And according to the Companies Act 1956, the maximum number of members in a partnership firm is 10 in the case of banking companies and 20 in the case of non-banking company. And according to the Companies Act 2013, it says that the maximum number should not be more than 100 and not specifically state a single number. It says that the maximum number of the members in a partnership firm should not be more than 100 according to the Companies Act 2013. So that is the second feature. And third one is sharing of profit. So you have seen that in the definition itself, it is states that it is sharing of profit. So in a partnership firm, the partners not only share a profit, they are sharing the losses also. So it's a significant component of a partnership firm that the accord between the partners, and they have to share gains and losses of a trading concern. So they have to share the profit as well as the loss also. And next is business motive. So as the motive of every business is making profit. So it's important for any firm to carry some kind of business that should have a profit gaining motive. So the similar thing in the partnership firm, in the case of a partnership firm also, the motive is profit making. And finally, the mutual business. We know the partners are the owners, and actually they are the agent of their firm. So any act of any one partner which will affect the other partners of the firm also. So it's a mutual business. If any problem will be made by any one partner, that will affect the other partner also. Actually, these are the these features which is clearly stated in the definition which is given in the law, the Indian Partnership Act 1932. So we move on the different types of partnership, and we have general partnership is there, limited partnership is there, and limited liability partnership is there. So first one, general partnership. So general partnership, it comprises two or more owners to run a business, and in this partnership each partner represents the firm with equal right. Every partner in the partnership firm is having equal right, and every partner, the all partners can participate in management activities and other decision making activities, and they have the right to control the business. So all partners is having an equal right in the management activities, decision making activities, and the control of the business also. And the profit, debts, and liabilities are equally shared and divided equally. So there's an equal form. The responsibilities are equal, and all the profit share are equal, and they have equal right in the firm. So that is in the case of a general partnership. And another one is limited partnership. I hope you have heard about limited liability partnership, and limited partnership and limited liability partnership. So limited partnership is different because it includes general partnership and general partners and limited partners also. So the limited partnership that includes general and limited partners. So we know the general partner have unlimited liability, but the limited partners is having limited liability. On the same time, the general partners manages the business and all the other limited partners. So that is in the case of a limited partnership. So limited partnership that includes general and limited partners, and these general partners have unlimited liability, and limited partners have limited control over the business, and they are not associated with the everyday operations of the business. And the general partners are actually make playing the business. So they are manages the business and all other limited partners in the firm. So another type is limited liability partnership. Commonly we call it as LLPs. So in LLPs, all the partners have limited liability, and each partner is guarded against other partners' legal and financial mistakes. And an LLP, this is almost similar to a limited liability company, but it is different from limited partnership or a general partnership. It's not like a limited partnership and not like a general partnership, but there is a similarity between the limited liability companies. And for those LLPs, all the partners have limited liability. So these are the common type of partnerships are general partnership, limited partnership, and limited liability partnership. So in limited liability partnership, which includes general and limited partners. So moving on to the next one, partnership agreement. We have already mentioned about the partnership agreement. So it may be oral or written. If it is written, we call it as partnership deed. So sometimes there is the partnership agreement is absent. So now we are looking into what are the rules applicable in absence of partnership agreement. So what are the things happen in a partnership firm if there is no agreement? So these are the things. Profit sharing. First is profit sharing. So in the absence of, if the agreement is silent or non-verbal, if it is there is no written agreement is there in the organization. So the profit among the partners are shared equally irrespective of their capital contribution. So if the partnership agreement is silent or if there is no written agreement is there, the partners are sharing their profit equally. And second one is interest on capital. So in these cases, normally no interest on capital shall be allowed. And if there is any provision, interest will be allowed only when there is profit. That is important. Only when there is profit, interest is allowed in the absence of partnership agreement. In other cases, no interest on capital is allowed to the persons in the absence of partnership agreement. And the third one, in the case of interest on drawings, the same thing. No interest is charged on in drawings. And another case is salary to a partner. If the salary to a partner, just a second. Sorry for the inconvenience. So salary to a partner. If it is not mentioned in the partnership agreement, no partner is entitled to receive a salary or commission, whatever it may be. And regarding the interest on loan also, 6% per annum interest will be allowed on a partner's loan to the firm. So that is in the case of interest on loan, 6% per annum. And in the case of salary, interest on drawings and interest on capital, nothing will be provided. And the last case, admission of a partner. We can, if the agreement is absent, in that case also, the partnership firm can admit a new partner only if they're getting the consent of all existing partner. Then only they can admit a new partner. So this is in the case of the partnership agreement is absent. What are the things, what are the rules applicable? They are sharing the profit equally. Interest on capital, there is no interest on capital is allowed. And if there is any provision, the interest will be allowed only when there is profit, and no interest in drawings will be charged, and no salary is provided. And the in the case of interest on loan, 6% per annum will be allowed, and only getting the consent of all the partners, all the existing partners, they can admit a new partner. So these are the cases. I hope it is clear. And we can move on to what are the different types of partner. Okay, I think this is important for your objective type questions. The statement will be given and you have to identify which type of partner is that. Okay, so simple actually. So first one is active or managing partner. So from the name itself, active partner means he is having an active interest in the business, and he's carrying on the business on behalf of other persons also. So he's active in the and he wants to retire. He has to give a public notice of retirement. If not, he is liable for all the activities by the firm. So because he is actively participating all the activities in the business, so he is called an active partner, or he's also called a managing partner. And second one is sleeping partner or a dormant partner. Actually, this is a partner, they contribute only share capital of the business, and he's getting the share of profit or losses, whatever may be. And but he's not actually participated in the business. And in the case of the retirement of his sleeping partner, he does not require to give any public notice. Okay, so in the case of an active partner, if he want to retire, he has to give a public notice. But in the case of a sleeping partner, does not require to give any public notice for his retirement. He is only contributing the share capital, and also he is getting the share of profit or losses, whatever may be from the business. And third type of partner is nominal partner or ostensible partner. Actually, is a partner. He doesn't have any real interest in the business, but gives his name to the firm. And he never contribute any capital. He doesn't get any profit share, and he doesn't have any voting power. But he is liable to outsiders as an actual partner, because other thing he is a partner. So actually, he doesn't have any real interest, but he gives his name to the firm here. So he doesn't have any capital contribution. He doesn't get any profit share. He doesn't have any voting right, but he is liable to outsiders as an actual, as an active partner. He is also liable for the things happen in the anything happen in the firm. Next one is a partner by estoppel and partner by holding out. So partner by estoppel means it's a partner who's not a partner of the firm, but he allows others to think that he is a partner through his behavior. So through his behavior, others think that he is a partner of the firm, but actually he is not a partner of the firm. Actually, there's a similarity. We think the partner by stop and partner by holding out, which is similar. Only a small difference between partner by stop and partner by holding out. A partner by holding out means actually who's not a partner but knowingly allow the firm to project to others that he is a partner of the firm. So, in the case of a partner by holding out, both the firm and that person, he knowingly allow others that he is a partner in the firm. But in the case of a partner by estoppel, only the persons through the behavior of the person only the others think that he is a partner in the firm. So that is the case of partner by estoppel and the partner by holding out. And another one is partner in profit only. So he is a partner who share only profit, not the losses. So uh, they share only profit and not the losses. And next is minor partner. So it's a partner whose the age of that partner is less than 18. And in the case of minor partner, the new firm cannot appoint a minor partner, but the existing partner can appoint a minor partner only after getting the consent of all other existing partners. And other things regarding the minor partner, like they can share profit, and also the liability of the minor partners is extend to the capital, the capital he contributed, and the other cannot file a suit against the minor. And the property which cannot be attached by the creditor, the property of the minor cannot be attached by the creditor. So these are the case of a minor partner. So no firm cannot appoint a minor partner, but the existing firm can appoint a minor partner only after getting the consent of all the existing partner. And next is outgoing partner, secret partner. So secret partners, it's a partner of the firm, but who doesn't want to disclose his relation with the firm to the public. He always want to be a secret. He doesn't want to disclose his name to the public. So that's called a secret partner. And outgoing partner is a partner who retires voluntarily from the firm without carrying the dissolution of the firm doesn't get dissoluted, but the partner want to voluntarily retire from the firm. That type of partner is called the outgoing partner. And finally, limited partners. Limited partners whose liable up to the value of his capital contribution to the business. So his liability is limited up to the capital contributed to the business. So these are the different types of partners: active partner, sleeping, nominal, then estoppel and holding out, secret partner, outgoing partner, and limited partner. So now we are moving to the partnership accounts. What are the accounts prepared in the by the partnership firm? So, like any other account, any other business firm, a partnership firm maintains accounts of its transactions. As the partnership has two or more partners, they have to prepare a separate capital account for each partners. Okay, so they have to prepare a separate capital account for each partners. And the capital account is prepared according to two methods. So the partnership firm can prepare their capital account of the partners in two forms. fixed capital method and fluctuating capital method. And when the partners agree to keep their capital at their original figures year after year, they are said to have fixed capitals. So they continue to appear at their original figures unless contribution is made like by way of additional capital or refund is allowed of the surplus capital. So they want to maintain their capital as fixed. So in that cases, they prepare two types of accounts, capital account and current account. And capital account of the partners includes their opening capital, additional capital, if there is any additional capital, and if there is any permanent withdrawal from the capital. So the capital account is prepared, and in addition to that, one more account is prepared, that is called a separate account called current account. And the current account is credited at the end of every year with the share of profit, interest on capital, salary, so any other remuneration. So these are the things which is credited in the current account of the partners and debited with the partners' drawings, interest on drawings, and share of loss if there is any share of loss. So this is the case of this is the case of preparing capital account according to the fixed capital method. They are preparing capital account and current account. So these are the different things, debited and the credited, and the capital account. Another method is fluctuating capital method. So fluctuating capital means what? It is one which changes from year to year. So when we are saying the fixed capital, the partners, they are agreed to keep their capital at their original figures year by year after year. But according to the fluctuating capital means the capital is one which changes from year to year, and only one account for each partner is prepared according to the fluctuating capital method, and all entries relating to interest, introduction of capital, interest on salary, then commission, if there is share of profit, everything is included only in the only one account. And this account is credited to the capital account, and similarly the capital account is debited with drawings, interest on drawings, and if there is any losses, so these are things which is debited in the capital account. So in under fluctuating capital method, only one account is prepared each year, and the account is credited with the introduction of fresh capital, interest on capital, salary, commission, and share of profit. And this account is debited with drawings, interest on drawings, and if there is any losses, these items are debited. So these are the things regarding the capital account. So two methods, fixed capital method and fluctuating capital method. So next we move on to the reconstitution of a partnership firm. So reconstitution means or reconstitution can be happened either in the way of admission of a new partner, or a retirement of a partner, or a death of a partner. So admission of a new partner means we are admitting a new partner after getting the consent of all the existing partner. So whenever a reconstitution is taken place in the partnership firm, the two things will be changed: the profit sharing and the another treatment is regarding the treatment regarding goodwill. So two things we have to take care of. So in the time of the admission of a new partner, we are preparing the sacrificing ratio. So we know the sacrificing ratio, which is the ratio in which all the partners are surrendering a portion of their profit in favor of the new partner. So that is called the sacrificing ratio. So they are sacrificing a part of the existing profit share on behalf of the new partner. So during that time, you have to calculate the sacrificing ratio, and the amount of goodwill have to be shared according to the sacrificing ratio. So in so many cases, we need the sacrificing ratio for sharing so many things. Okay, and sacrificing ratio is calculated by deducting. So this is the difference between all the profit sharing ratio and the new profit sharing ratio. So this another reconstitution in the case of a retirement of a partner. At that time, we have to calculate the gaining ratio. That whenever a partner is retired or the existing partners, the continuing partners will gain a certain portion of profit from the retiring partners. That particular ratio is called gaining ratio. It is calculated by subtracting old profit sharing ratio from the new profit sharing ratio. So now we move on to the goodwill, treatment of goodwill at the time of admission. So earlier I mentioned that whenever the reconstitution of a firm is taken place, the two things, the two things will be changed: their profit sharing ratio and the goodwill. You have to take care of these two things, and the treatment of goodwill at the time of admission. So we know that at the time of admission, the new partner is required to bring his share of goodwill to the firm. So at the time of admission of a partner, you have to the goodwill should be valued as per the agreement among the existing partners. So different treatments are when the premium paid privately. Okay, if the new partner is paid the goodwill privately, no adjustment is required in the business as it is outside the previous business. So no adjustments or no increase is required there. But the second case is new partner being goodwill in cash and retained in the business. So he bring goodwill in cash and is retaining that the amount of goodwill in the business also. So the first entry shows that for the share of goodwill brought in by the new partner. So you have to make two journal entries, and this is very important for your exam. And the previous year question shows that these types of questions will be asked. So you have to identify the journal entries. So which item should be debited, which item should be credited. So you have to take care of these things. Okay. So the first journal entry shows the for the share of goodwill brought in by the new partner, and the entry will be the cash or bank account debtor to premium for goodwill account. And we said that that amount is retained in the business. So that amount is shared by the existing partners because they are sacrificing, the existing partners will sacrifice their profit share on behalf of the new partner. So we are adjusting the goodwill to sacrificing partners in their sacrificing ratio. And this is important. The goodwill brought by the partner is shared among the existing partners in their sacrificing ratio. So the entry will be premium for goodwill account debtor to sacrificing partners capital account. I think one question was there. One question was there regarding for adjusting the goodwill to sacrificing partners in their sacrificing ratio. So next case is share of goodwill brought in kind. So the second case was the new partner is bringing the goodwill as cash, and the third case is the new partner is bringing goodwill in kind. Kind means asset. Okay, so instead of this cash, we written down as assets account debtor to incoming partner's capital account to premium for goodwill account. So for asset bought by incoming partner, the entry will be we are debiting the assets and crediting the incoming partner's capital account and premium for goodwill account. And the same for adjusting this goodwill to sacrificing partners in their sacrificing ratio is also shared among the existing partners in their sacrificing ratio. So the entry will be premium for goodwill account debtor to sacrificing partner capital account. So this is the case of share of goodwill brought in kind by the new partner, by the incoming partner. And finally, when the new partner So another case is when the new partner does not bring his share of goodwill in cash. There are certain cases the new partner he is not able to bring his share of goodwill in cash. In that cases, we are debiting the incoming partner's capital account and crediting the sacrificing partner's capital account in their sacrificing ratio. Okay, so this journal entry is also important. When the new partner, the incoming partner, sometimes he is not willing to or he is not able to bring the share of goodwill in cash. So we have to debit the new partner's capital account, that's the incoming partner's capital account, and have to credit the sacrificing partner's capital account in their sacrificing ratio. So these are the cases or the treatment of goodwill at the time of admission. So first case, the new partner is bringing the goodwill in cash. Two journal entries are there for the share of goodwill brought in by the new partner and for adjusting the goodwill to sacrificing partners in their sacrificing ratio. And second case, third case was the new partner is bringing his goodwill in kind and he is not able to bring his share of goodwill in cash. So in that case, partner's capital account is debited and the existing partners, that is sacrificing partners, capital account is credited. And this is the treatment of goodwill at the time of retirement. And we know the retirement partner or the deceased partner. Deceased partner is entitled to entitled to his share of goodwill at the time of retirement or at the time of death of the partner, because that goodwill is earned by the firm as a result of that partners also, right? So they are having a right to share the goodwill at the time of retirement or at the time of the death of a partner, whatever it is. So in the since the future profits will arise because of the present goodwill, they are having a right to share the goodwill also. So the journal entry is the continuing partners capital account. So that will be in their gaining ratio to retiring or deceased partner capital account. So this is the journal entry or the treatment of goodwill at the time of the retirement or the death of a partner. Okay. So dissolution. So dissolution means dissolution of partnership is there and dissolution of firm is there. Okay. So these two things are different. So dissolution of a partnership are in the form of, it may be a reconstitution in the relationship between the partners, or it may be the change in profit sharing, or it may be by the admission or by the retirement or by the death of a partner, and it may be by the insolvency of a partner or by the expiry of a period. So the partnership is became dissoluted. So on the other hand, partnership, the dissolution of a partnership firm means which means the discontinuing of the business under the name of the said partnership firm. And in these cases, all the liabilities are finally settled and they are selling of all the assets, or they are transferring to a particular partner, or settling all the accounts that existed with the partnership firm. So this is the end of a firm. That's called, they are discontinuing the whole business. And this dissolution can be happened in the form of, there are so many cases by which dissolution has happened. The first one is dissolution by agreement. So either with the consent of all the partners or in accordance with the contract between the partners, they are agreed to discontinue the business. So by the mutual agreement between the partners itself, they are discontinuing the business. That is called dissolution by agreement. Okay. And a second one is compulsory dissolution. There are cases, sometimes all the partners or sometimes except one partner becoming insolvent or insane, and in some other cases where the business become illegal, or sometimes all the partners except one decide to retire the business, or where all the partners or except one died. In these cases, the partnership firm cannot continue. So they have to compulsory discontinue the firm. So these are the cases under which the firm have to discontinue. The cases are all the partners or all the or except one partner become insolvent, or the business become illegal. So these are the cases in which the compulsory dissolution will take place. And another case is dissolution of the happening of contingencies. So due to contingencies, the firm get discontinued. The cases may be by the death of a partner, or by the completion of the venture for which it was established. Because that partnership firm was established for a particular venture. That venture get completed, so they can discontinue the partnership business. And another case is dissolution by notice. So sometimes the partnership firm may be dissolved if any partner they give notice in writing to all other partners to his intention to dissolve the firm. So and it is also called a dissolution of partnership at will. So any one of the partner is giving notice in writing that he want to dissolve the firm. So in that case, is also they are discontinuing the firm or they are dissoluted the firm. So that is one another case. And finally, dissolution by court. In that in that also the firm can discontinue. Any one of the partner set up sue petition, or when a partner is guilty or misconduct, or when the partner deliberately and continually commits breach of agreement. In that cases, the court can make a notice and discontinue the partnership firm. So these are the case of dissolution of a firm. So dissolution of a firm and dissolution of a partnership is different, and the firm can discontinue through agreement or compulsory resolution, or through happening of different contingencies, or by notice given by the court. These are the cases. So now we are moving to the accounting for non-profit organization. So we know there are certain organizations which are set up for providing services to its members, and such organization includes some clubs, some charitable institutions, some schools, religions organizations. So those are called non-profit organizations, right? Actually, these organizations do not undertake any business activity, or their motive is not making profit, but they have to prepare certain accounts. So the different accounts they need to prepare they need to prepare our receipts and payment account, and income and expenditure account, and balance sheet. So these are the three accounts a non-profit organization have to prepare. Okay. So you know that receipt and payment account is a real account. Actually, it is a summary of cash and bank transaction. And based on this receipt and payment account, we are preparing the income and expenditure account. Okay. So income and expenditure account is always similar to profit and loss account, and which helps to calculate or ascertain the surplus or deficit. And finally, we have to prepare a balance sheet. So these are the three accounts they have prepared by a non-profit organization. And now we are moving to the costing concepts. These are some basics of costing. Okay. So first of all, what's the cost? We know that cost is a total expenses for manufacturing a product, and costing is a technique which helps to ascertain the cost of a product, right? So that cost means the total expenses, and costing, that is a technique which helps to ascertain the cost of a particular product. So we know the management requirement. The management requirement are different, right? Sometimes the financial accounting fails to provide answers to all questions raised by the management. So in that cases, the regarding the cost control or the expenses, in that cases, cost accounting can provide a solution for the problems raised by the management. So the object is, the first one is cost recording. Okay, cost recording means simply recording the cost of all the transaction in the cost books. So in cost accounting, we are preparing cost books. So simply recording all the recording the cost of all the transactions. And the another object is cost estimation. Estimation means what? We are predetermining the cost of a product, right? So we are predetermining the cost of a product that we want to manufacture, or we want to in the case of a service that we want to render the service. Okay, so we are predetermining, or we are estimating the cost of a product. That may be, that may not be the actual cost. We are predetermining the cost of that particular product. And another object is cost ascertainment. Actually, cost ascertainment means after the production of a product, or after rendering the service, or based on the actual data, we are estimating, or we are ascertaining the cost. So cost estimation and this and ascertainment is different. In cost estimation, we are predetermining the cost, okay, based on our experience. But under the cost ascertainment, we are ascertaining the cost based on the actual data, which means after producing a particular product, or after rendering the service, we are we are ascertaining the actual cost. Okay, then next one is cost control. We know cost control means we have to reduce the cost by eliminating wastages in cost of material, cost of labor, or all other expenses in the firm. Okay, so that is cost control. We want to eliminate all the wastages. Clear? Then another is cost reduction. Cost reduction means actually we need to permanently reduce the cost per unit of goods manufactured or services rendered without affecting their quality or suitability. So we have to permanently reduce the cost without compromising the quality of the product. So that is cost reduction. So cost control and cost reduction is an important objective of costing. And next is decision making. So we know the success of any organization which is depends upon the timely decision taken by the management, and this data, the costing data, which helps the management to take decisions on time. So these are the objectives of costing, and these are some concepts regarding concepts in costing. First one is cost unit. A cost unit എന്ന് പറയുമ്പോൾ cost unit is a unit of a product or a service or time in relation to which cost may be ascertained or expressed for the purpose of cost control and cost reduction. And actually the cost unit is also called a cost base. Some examples like for cement, the cost unit is per ton, and for sugar also we are using per ton. If it is electricity, we are using per kilowatt per hour. For hotels, we are using per room per day, or hospitals per bed per day. So these are the cost unit. It's a unit of that product or the service or the time in relation to which a cost may be ascertained. And another concept is cost center. Actually, it is a subunit. So it is an organizational subunit, and it may be a department or a location or a person or a group of persons. So these are called cost centers. So it is an organizational subunit or it is the smallest segment of an activity for which cost is ascertained for the cost control and cost reduction. Clear? So this is a cost center. So that may be like a department or a section or a location in a. And next is cost object. Cost object means actually it's a separate measurement. So it's an object for which a separate, so for some items, separate measurement is required. It may be like a product, or it may be like a service, it may be like a activity. So for those things, for those objects, they need a separate measurement. Okay, like these are called cost objects. And finally, profit centers are there. It's another concept. So profit center means which are normally created to delegate the responsibility to individuals and to measure their performance. Normally, it is created for delegation of responsibility, and it is established to maximize their profits. So, like a cost center, profit center is also an organization subunit uh, where which the profits is clearly ascertained, or they are created for delegation of responsibility. So that is profit center. We have seen the cost centers which are facilitating cost control and cost reduction, but the profit center which is created for delegation of responsibility. And the main objective of cost center are to minimize the cost, but the objective of profit center to maximize their profit. So cost center which is related, that is also in a separate unit, a separate subunit of organization subunit, but the objectives are different. One is concerned with the cost and other is concerned with the profit. Okay. And now different types of cost. And this is also important for your objective type questions. So first one is historical cost. Historical cost means, that is a past cost, right? So whenever we are determining the cost only after the production, that costs are called historical cost, or the past cost we call it. Okay. Then sunk cost. Sunk cost means actually those are irrecoverable cost, and which doesn't have any influence in the future decision making. For example, if the company uh, in company the taken place a replacement of an asset, the undepreciated value of existing asset is a sunk cost. So those costs are irrecoverable and which doesn't have any influence in the future decision making. That type of cost are called sunk cost. Another one is marginal cost. You know that marginal means additional. So whenever you are producing an extra unit, so additional cost will be there. So that cost is called marginal cost. Then imputed cost is there. Imputed cost is also called notional cost. Actually, these costs are imaginary cost. Okay, so like rent on building, interest on capital. Actually, these costs are charged in the book, but they are not paid anymore, right? So these are imaginary figures. So these costs are called notional cost or imputed cost. Okay, then estimated cost. So we are those are the predetermined cost. We are sometimes we are determined the cost in advance. So after considering all the factors which will influence the cost, we are predetermining certain cost that are called estimated cost. Another type is standard cost are there. Standard cost are actually it is assigned. We can call it a scientifically estimated cost. So scientifically estimated cost are called standard cost. Normally, the standard cost provide a yardstick against the actual cost are compared. So we are comparing the actual cost against this standard cost. This is a yardstick. Okay, and next is conversion cost. So whenever we are converting the direct material into finished goods or fully finished goods or partly finished goods. So what are the costs incurred in uh, converting something from one stage to or one form to another form? So that cost are called conversion cost. So next is differential cost. Differential cost means actually that is the difference between cost between two levels of activities. So, if the change increases the cost, it is known as incremental cost. And if the change decreases the cost, it is known as the decremental cost. Okay, so that's a differential cost. Two activities are there. So, in the conversion cost, we said whenever we are converting the raw material to the finished goods, so one conversion is happening there. Okay, so they are changing the form of raw material to maybe a fully finished goods or a partly finished goods, whatever it may be, some changes is happening there, right? Okay, so in differential cost means it's the difference in cost between two levels of activities. Okay, then next is ordering cost. Ordering cost, it's a cost of placing one order at a time to purchase a particular material, and which includes all the cost for getting an item into the firm's inventory. So that is ordering cost. And finally, carrying cost is there. Carrying cost is the cost which is incurred on carrying or storing or maintaining inventory in the store. So that is called carrying cost. So these are the different types of cost. Historical cost is the past cost, which is determined only after the production, and sunk cost is there. Sunk cost means these are irrecoverable costs, and it doesn't have any influence in the future decision making. And marginal cost is there, which is an additional cost incurred for producing an additional unit. And imputed cost or notional cost is there, that is imaginary charges, not an actual cost. Then estimated costs are predetermined the cost, or we are determining the cost in advance. And the standard cost means these are the scientifically estimated costs are called standard cost. And conversion cost is there whenever we are converting raw material to some other form. The cost incurred in that stage is called conversion cost. And differential cost means it is a difference in cost between two levels of activities. Sometimes it will increase the cost and sometimes it will decrease the cost. If it increase the cost, the different two levels, if it increase the cost, it is incremental. If it decrease the cost, that is decremental costing. And we have ordering cost is there for the cost for placing on order, and carrying cost, which is incurred on carrying or storing or maintaining the inventory. So to the last portion, unit costing or output costing. So unit costing is also an important method of costing, and which is normally applied in those industries where production is continuous. In that cases, we are applying this unit cost there, and also this method is used in those industries in which the units produced are identical. So mainly in two cases, this unit costing is applied. Those industries, their production is continuous and they are producing identical products. In that cases, we are using this unit costing, and this method is used to ascertain the cost per unit of a product. So the equation is total cost divided by number of cost, and this unit cost is also called a single or output cost. Okay, and the normally the physical units which we used to measure in unit cost, like ton, kilogram, meter, these are the different measurement we are using in for measuring the physical units of different products. So that is all about unit costing. So it's a method, it's a costing method, and this costing is applied in those industries where production is continuous and the units produced are identical. So these are the things which I want to cover, and the rest of the portion will be taken by the taken by Dr. Arati.
Thank you, Ashwati teacher. Now I request the participants to raise your questions. You can ask the question through your mic or you can put that in the chat box. We will read it. If you have any doubts, you may ask it. Or we can move to the next session. I think there are no questions, teacher. So we will move to the next session. If you have any question, you can ask that in the end. I invite Dr. Arati C, who is an assistant professor on contract of Department of Commerce, University of Kerala. Arati teacher.
Hi, Reshma. Okay. Good evening.
Good evening, teacher. Can we start?
Okay.
Okay, teacher. Over to you.
Okay, good evening. I'm Dr. Advisi, Assistant Professor on Contract, Department of Commerce, University of Kerala. Can we start the session? Can you see this?
Yes, teacher. You're
Okay.
visible.
Okay. Okay. And the topics covered are, I will be covered is the consignment, joint venture, insurance claim, accounting for issue and reissue of shares, for features of shares and accounting standards. So the first topic is consignment. You all know that what is consignment? Consignment, it is a type of business arrangement in which the one person send goods to another person for sale on his behalf. What is consignment? It is the type of business arrangement and in which this one person send goods to another person for sale on his behalf. And the person who sent goods is called a consigner and the person who receives the goods is called a consignee. So these are the main terms included in the consignment, consigner and the consignee. The consigner is the person who sent goods and the who receive goods is called a consignee. And the benefit of this consignment is that the consigner get the profit and the consignee get the commission for their sales. So these are about consignment. It is the business type arrangement in which one person send goods to another person for sale on his behalf. The main terms used in consignment is consigner, the person who sends goods, and the consignee means the person who receives the good is called consignee. The next is consignment agreement. It is a legal agreement between consigner and consignee. It is a legal written agreement between the consigner and consignee. It includes the terms and conditions of the consignment. It also includes the commission of the consignee. So these are the main terms used in the consignment. Consigner, consignee, and the consignment agreement. Next is Performa invoice. This is also a main term used in this consignment. It is a statement. It is a statement sent by the consigner to the consignee along with the goods sent. So it is a statement. It is a statement showing the details of goods sent by the consigner to the consignee regarding this quantity of the product, its price, etc. These are the details in these statements. So these statements were sent by the consigner to the consignee. So what is performa invoice? It is the statement showing the details of the quantity and price of the product, etc. from sent by the consigner to the consignee along with the goods. Next is non-recurring expenses. The non-recurring expenses, these are the expenses incurred by the consigner. So these expenses are incurred by the consigner to dispatch the goods from his place to the place of consignee are called non-recurring expenses. So what is non-recurring expense? It is the expense incurred by the consigner for dispatching the goods from their place to the place of consignee. The examples of these non-recurring expenses are packing and forwarding, loading and unloading, carriage and cartage, freight and railway charges, customs, etc. These are the examples of non-recurring expenses. So it is the expenses incurred by the consigner to dispatch the goods from his place to the place of consignee. It includes packing and forwarding charges, loading and unloading charges, carriage and cartage, freight and railway charge, customs, etc. And these expenses are added to the cost of goods sold at the time of calculation. The another expense is recurring expenses. And these expenses, the non-recurring expenses are incurred by the consignor and the recurring expenses are incurred by the consignee. So these are the difference between these two expenses. Non-recurring expenses are incurred by the consignor and the recurring expenses are incurred by the consignee. And these expenses incurred after the goods reach his place. So this is also called a maintenance of goods expense. So these expenses are incurred after the goods placed in the goods reach the place of consignee. And this also called maintenance of good expenses. The example of recurring expenses are advertising, selling expenses, go down expenses, carriage forward, salesman salaries, etc. These are the examples of recurring expenses. Once more, advertising, selling expenses, go down expenses, carriage outward, salesman salaries, etc. These are the examples of recurring expenses. The next term is account sale. Like performa invoice, account sale is also a statement. But on the contrary, it is the statement forwarded by the consignee to the consigner. And the performa invoice is the statement forwarded by the consigner to the consignee. But on the contrary, the account sale is the statement forwarded by the consignee to the consigner. And it contains the details of goods sold, amount received, expenses incurred, commission charge, advance payment, etc. So, what examples of account sales include? It includes the details of goods sold, amount received, expenses incurred, commission, etc. So, account sale is the statement forwarded by the consigner to the consignee to consigner. And the performa invoice is the statement forwarded by the consigner to consignee. Next is commission. Commission, you all know that what is commission. On the basis of this total sales, commission is calculated, and commission is the reward or consideration for the sale of goods on behalf of the consigner. It is as per the consignment agreement. The percentage of commission is stated in the consignment agreement. So mainly there are three types of commission. First one is simple commission. So its calculation is very simple, that the fixed percentage is given as, for example, 5 or 10%. You have to calculate from total sales. If the total sales is 1 lakh, then the percentage is 10. So you have to calculate 1 lakh into 10 by 100. That is the commission. The calculation is simple. Just apply the fixed percentage on total sales. And then next is overriding commission. It is also called incentive. It is in the form of incentives because it is given for giving an extraordinary sale of goods. Some specific amount is payable to consignee in the form of incentive is called overriding commission. It is also calculated on the basis of total sales. It is the extra for it is given in the form of incentives for extraordinary sale of goods. It is called overriding commission. And the last one is del credit commission. And it is the del credit commission is allowed by the consignor to the consignee for taking responsibility of the bad debt that may arise. Because it is allowed by the consignor to consignee for taking the responsibility of bad debt. And the consignee take the responsibility of bad debt, and then the consignor will give him the del credit commission. It is usually allowed in the case of credit sales. And it is also calculated on the basis of total sales. So there are mainly three types of commission: simple, overriding commission, and del credit commission. In simple commission, it is the fixed percentage you have to apply it on total sales. In the case of overriding commission, it is in the form of incentives for the extraordinary sale of goods. And the last one is del credit commission. It is for the taking the responsibility of bad debt, and it is usually allowed in the case of credit sales. And it is also calculated on the basis of total sales. These are the formula for valuation of stock. First, you have to calculate the cost price of unsold units and then add two items, that is proportionate non-recurring expenses by consignor and consignee. So just you have to just add the non-recurring expenses by consignor and consignee, then you will get the cost of unsold stock. So first you calculate the cost price of unsold unit and add what the proportionate non-recurring expense of consignor and consignee, then you will get the cost of unsold stock. This is the formula of valuation of stock. Next is calculation of consignment stock in losses. How to calculate the consignment stock in losses? There are two types of losses, that is normal loss and abnormal loss. The normal loss is due to, we expect the normal loss, but we can't avoid it. It is called a normal loss because it is due to evaporation, leakage, drying, etc. We know that this loss will be happened. We expecting this loss, but it cannot be avoidable. So these losses are called normal losses, and this can be calculated as the cost per unit equal to total cost plus expenses incurred divided by total quantity minus normal loss. These are the formula for calculating the normal losses, that is total cost plus expenses incurred divided by total quantity minus normal loss. And in the case of abnormal loss, it is an accidental loss. It is caused due to accident or caused by some carelessness. So examples are loss by theft or fire, earthquake, flood, accident, etc. This type of losses are come under abnormal losses. It can be avoided. So this abnormal loss can be calculated under this formula, that is valuation of abnormal loss during transit. First you have to write the cost of goods lost in transit. Then add proportionate expenses paid by the consignor. Then you will get the value of abnormal loss during transit. The expenses paid by the consignor into abnormal loss in units divided by quantity of goods consigned. This is the proportionate expenses paid by the consignor. Is the expenses paid by the consignor into abnormal loss in units divided by quantity of goods consigned. So then you will add this amount to the cost of goods lost in transit, then you will get the value of abnormal loss during transit. So these are the two losses, normal loss and abnormal loss. Normal loss will be calculated as total cost plus expenses incurred divided by total quantity minus normal loss. And abnormal loss is calculated under the formula cost of goods lost in transit plus proportionate expenses paid by the consignor. Then you will get value of abnormal loss during transit. So these are about the consignment. The terms used in the consignment, valuation of stock, and the calculation of consignment stock in losses. Next is joint venture. The joint venture, it is a short-term business undertaking jointly by two or more persons who share the profit and losses in an agreed ratio. If there is no such agreement, then it is shared equally by the two parties. So this is the joint venture. It is joined by two or more persons to share the profit equally or in an agreed ratio. Next, the term is co-venturers. The co-venturers is the parties who have agreed to undertake the joint venture are called co-ventures or joint ventures. The parties, the persons who involved in this joint venture is called co-venturers or joint ventures. Next is methods of maintaining joint venture accounts. There are mainly two different methods of recording joint venture transactions. The first one is when separate set of books are maintained, and the second one is when separate set of books are not maintained. So first we move on to the first method, that is when separate set of books are maintained. Under this system, mainly three accounts are prepared, that is joint bank account, joint venture account, and co-venturers account. Three accounts are prepared under separate sets of books are maintained. So, what is joint bank account? When these co-venturers open separate bank account for joint venture transaction by making their initial contribution. Their initial contribution means their capital. So, they open separate bank account for contributing their contributions, their capital. So it is opened jointly by all the co-ventures. This is the joint bank account. So next is joint venture account. This account is prepared for the purpose of ascertainment of joint venture profit. So this account is used to know the profit of the joint venture. And here the debit all the expenses and credit all the incomes. So joint venture account is ascertained for to know the profit of the joint venture, and in this account debit all expenses and credit all incomes. So venture profit or loss that ascertained from this account is transferred to co-ventures account. If there is profit or loss, then it is transferred to co-ventures account. And the last account is co-ventures account. It is the personal account of ventures are maintained to keep record of their contributions of cash, goods, or meeting venture expenditure. So the co-ventures account is a personal account of ventures. So it is used to record the contributions of their contributions of cash, goods, etc. These contributions are maintained in the this co-ventures account. So this ventures profit or loss is also transferred to this co-ventures account. And this account is closed simultaneously with the closure of joint bank account. So these are the three main accounts prepared under the when separate sets of books are maintained. First one is joint bank account, joint venture account, and co-ventures account. The second method is when separate sets of books is not maintained. In this case, only two accounts will be prepared, that is joint venture account and other co-ventures account. So the joint venture account it is a nominal account, and in case it debit all the expense, whether it is capital or revenue, you have to debit all these expenses and credit all the incomes. So the balancing figure, it will be profit or loss. It is transferred to co-ventures account in agreed profit sharing ratio. And then second account is other co-ventures. It is also a personal account. It records the transactions of the other co-ventures only. Their transaction is recorded in this account. The balancing figure in the account is the amount of final settlement. So there are mainly two accounts will be prepared under this method. The first one is joint venture account, and it is a nominal account and debit all the expenses respective of whether it is capital or revenue and credit all the incomes. So, and the balancing figure is transferred to co-ventures account according to their profit sharing ratio. And the second account is co-ventures account. It is a personal account and it records the transaction of other co-ventures only, and the balancing figure is the final settlement of their. So these are the two accounts you have to prepare in the case of joint venture. The first one is when separate set of books are maintained, three accounts will be prepared: joint bank account, joint venture account, and co-ventures account. And when there is no such a set of book of accounts is maintained, then it is joint ventures account and co-ventures account should be prepared. Next is the difference between joint venture and consignment. And the first one is the nature of it. It is a temporary partnership business without a firm name. And in the case of consignment, it is an extension of business by principal through agent. So the relation between the consignment is the principal and agent relationship between the consignor and consignee in the case of consignment. But in the case of joint venture, it is a temporary partnership without a firm name. And the parties involved in joint ventures are known as co-ventures. But in the case of consignment, it is consignor and consignee. So the relation between the venture is just like the partners in the partnership. But in the case of consignment, the relationship is between the consignor and consignee is like principal and agent. Next is about the sharing profit. The profit and losses of joint ventures are shared among the co-ventures in their agreed proportion. In the case of consignment, there is no such sharing. Consignee only get the commission and consignor get the profit. Next is about the rights. The co-ventures have equal rights. All the co-ventures are equal rights. But in the case of consignment, the consignor enjoys the principal rights and the consignee enjoys the agent rights. In the case of exchange of information, the co-ventures exchange the required information among them regularly. And in the case of consignment, the consignee prepare an account on sale which contains the details of business activities and is sent to the consignor. Ownership. All the co-ventures are the owners of the joint venture. They are the owners. But in the case this, the consignor is the owner, not the consignee. Method of maintaining accounts. There are different methods to maintain in joint venture, like joint bank account, joint venture account, other co-ventures account, etc. And as per the agreement, the co-ventures maintain their account. But in the case of consignment, there is only one method of accounting. Basis of account. This joint venture account is applicable on cash basis. But in the case of consignment, it is actual basis is adopted in consignment. And the last is continuity. The continuity is after the venture is completed, the joint venture is terminated. But in the case of consignment, the continuity exists according to the willingness of both consignor and consignee. So there are mainly 10 differences between the joint venture and consignment about their nature, parties, relation, sharing profit, rights, exchange of information, ownership, method of maintaining accounts, basis of account continuity. These are the main difference between joint venture and consignment. Next is insurance claim. You all know that what is insurance. So this is the insurance claim by the business organization. So to safeguard the business from the unforeseen losses like fire, other damages from the earthquakes, flood, etc. So the business entities buy some insurance policies to cover this loss of stock. In consideration of the premium, the insurance company take the responsibility to compensate. So this is about insurance claim. So there are mainly two types of claims: claims for loss of stock and claims for loss of profit. First, we discuss about claim for loss of stock. And this claim can be studied under two heads. The first one is total loss and the next is partial loss. The total loss. The total loss, in the case of total loss, the amount of claim is actual loss. The condition is if goods are fully insured, but the amount of claim is restricted to the policy amount. In the if a company, for example, if a company take a amount insurance of fully insured goods, then the actual loss, whatever the amount that is, if it is 5 lakh, then you will get the actual loss amount in the case of total loss. But the next is partial loss. This can be calculated under two heads: without average clause and with average clause. Without, in the case of without average clause, the claim is lower of actual loss or sum insured. The two amounts are there: actual loss amount and sum insured. Whichever is lower, you will get that amount. In the case of without average clause. But in the case of average clause, the claim is calculated under this formula: is loss of stock into sum insured divided by insurable amount. That is total cost. The first is without average clause. It is calculation is easy. You have to choose which amount is lower, actual loss or sum insured, and you have to take that amount for calculation. But in the case of average clause, this formula is applied, that is loss of stock into sum insured divided by insurable amount or total cost. These are the two methods to calculate claim for loss of stock. First one is total loss, and you will get the actual loss. And in the case of partial loss, there are two heads: without average class and with average class. Without average class, lower of the two amount, actual loss or sum insured. But with average class, the formula is loss of stock into sum insured divided by insurable amount. So this is the formula for calculating the loss of stock. This is first value of stock on date of fire, that is closing stock, and then less value of salvaged stock. Then you will get the amount of loss of stock. First, you write the closing stock, that is value of stock on date of fire, then less value of salvaged stock, then you will get amount of loss of stock. And this loss of stock should be applied in average clause. This loss of stock amount into sum insured divided by insurable amount. Then you will get the average clause. That is proportionate amount given to the business organization as insurance claim. Next is claim for loss of stock, or otherwise known as consequential loss insurance. This is the second type of insurance claim. The consequential loss insurance or loss of profit insurance is a business that has to be discontinued or interrupted for some times due to this fire or any types of damage. A normal fire policy only identifies loss of stock or assets and fail to ensure any loss of profit suffered by the concerned business. Therefore, consequential loss policy should be taken to cover the loss of profit, loss of fixed expenditure, etc. So what is consequential loss of insurance? Because when a fire occurs, in addition to the direct loss on account of stock or asset destroyed, there is a consequential loss as business has to be discontinued or interrupted for some time. So consequential loss arise due to the loss of profit that would have been earned during the discontinuous period. Convenience of standing charges like salary, rent, etc. during the discontinuous period and increase the cost of working. So, so these losses can be insured by a loss of profit policy or consequential policy. So the loss and the loss varies due to the discontinue or interruption of business activities is called consequential loss. So in order to cover this loss, you have to take a consequential loss policy. The main terms come under this consequential loss insurance is insured standing charges. Insured standing charges, these are the examples of insured standing charges, that is salaries to staff, rent rates and taxes, wages to skilled workers, auditors fee, traveling expenses, interest on debentures, etc. So these are the insured standing charges. It means which continue in the interruption period like these expenses are not discontinued. Whatever happens in the business organization, these charges will have to be paid. It is not discontinued, it is continued. So you have whatever happens in the organization, you have to pay salaries to the permanent staff, you have to pay the rent rates and taxes, you have to pay the interest on debentures. So these charges can be discontinued, it can be continued whatever happened to the business. So these charges are called insured standing charges. Next is turnover. Turnover means what is it? Is the it includes goods sold or services for which amount is payable. It also need to be insured. And the next is annual turnover. It is the period of last 12 months immediately preceding to the date of fire. It is the last 12 months before the date of fire, immediately preceding. That means before the date of fire. That 12 months is called annual turnover. Next is standard turnover. It means the turnover for the period corresponding with the indemnity period during the preceding accounting year. What is that? It is the turnover for the period corresponding with the indemnity period during the preceding accounting year. That means 12 years immediately 12 years immediately preceding the date of fire, which corresponds to the indemnity period. For example, if a fire occurred on 1st May 2017, having the indemnity period of 3 months, that means it starts from on 1st May 2017 to 1st August 2017. These 3 months are the indemnity period. So that is 1st May 2017 to 1st August 2017. These are the 3 indemnity periods. So what is the standard turnover? That is corresponding, the period corresponding with the indemnity period during the preceding accounting year. The fire was occurred in 2017. So the preceding accounting year is 2016. The same year when the fire occurred is 2017. The same time period of the preceding year, that is 2016. So the standard turnover is the period from 1st May 2016 to 1st August 2016. The only change is that the year will change. The fire occurs in 17, then the standard turnover period is in 16. The date and they all are same, but the year is changed. So this is the standard turnover. It means the turnover for the period corresponding with the indemnity period during the preceding accounting year. The indemnity period in the same period, but year preceding year. 2017 ഫയർ എങ്കിൽ 2016 ഇയർ മാത്രമേ മാറുള്ളൂ, ടൈം പീരീഡ് സെയിം ആയിരിക്കും. ദാറ്റ് ഈസ് കോൾഡ് സ്റ്റാൻഡേർഡ് ടേൺ ഓവർ. നെക്സ്റ്റ് ഈസ് ഗ്രോസ് പ്രോഫിറ്റ്. ഇറ്റ് ഈസ് കാൽക്കുലേറ്റഡ് ആസ് the net profit plus insured standing charges. It is called gross profit. These two items are added, then you will get the gross profit. Next is net profit. So profit excluding tax, it includes the detailed insured standing charges, other charges, depreciation, and other provisions of this. These items are adjusted, then you will get the net profit. Next is indemnity period. It is a period maximum 12 months during which the result of the business affected due to damage. And this period is selected by the insured person. The period is maximum 12 months during which the result of the business affected due to damage. ഡാമേജ് ഉണ്ടായ ആ പീരീഡ്, അതിനെയാണ് നമ്മൾ ഇൻഡെമിനിറ്റി പീരീഡ് എന്ന് പറയുന്നത്. ഏതൊക്കെ ടൈമിലാണ് ഡാമേജ് ഉണ്ടായത്? 3 months ആണെങ്കിൽ 3 months, 5 months ആണെങ്കിൽ 5 months. പക്ഷെ 12 months എക്സീഡ് ചെയ്യാൻ പാടില്ല. അതിനെയാണ് നമ്മൾ ഇൻഡെമിനിറ്റി പീരീഡ് എന്ന് പറയുന്നത്. നമ്മുടെ ഒരു ഫയർ ഉണ്ടായി ആ ദിവസം തൊട്ട് അത് ശരിയാവുന്നത് വരെയുള്ള ആ പീരീഡ്, അതിനെയാണ് നമ്മൾ ഇൻഡെമിനിറ്റി പീരീഡ് എന്ന് പറയുന്നത്. These are the main terms included in the insurance claim. So first insurance claim can be calculated under two heads, that is claim for loss of stock and claim for loss of profit. And this stock can be calculated under these two heads, total loss and partial loss. This is a formula for calculating the loss of stock. And this next is claim for loss of profit or consequential loss. These are the main terms involved in this consequential loss of insurance, that is insured standing charges that cannot be discontinued. Next is annual turnover, that is 12 months immediately preceding the date of fire. Standard turnover is the period corresponding with the indemnity period, but this is during the preceding accounting year. Next is gross profit, that is calculated as net profit plus insured standing charges. Then about net profit, and last is indemnity period, that is maximum of 12 months during which the result of business affected due to damage. And this period is selected by the insured person. These are about the insurance claim. Next is moving on to the next topic, accounting for issue, reissue, and forfeiture of shares. You all know that what is share. What are the kinds of shares? That is authorized capital, kinds of share capital like authorized capital, issued capital, subscribed capital, called up capital, paid up capital, etc. These are the kinds of share capital. What is authorized capital? Authorized capital is the amount which is stated in the memorandum of association. That amount is stated in the memorandum of association, and it is a maximum capital for which a company is authorized to issue shares. It is the maximum capital for which a company is authorized to issue shares during their lifetime. It is also called a nominal capital or registered capital. Next is issued capital. It is also a part of authorized capital, and it is actually issued by the company. Thus, capital is called issued capital. Next is subscribed capital, and it is that part of issued capital which is actually subscribed by the public. Called up capital is also a part of subscribed capital with regard to which calls have been made. And the paid up capital is part of the called up capital which is actually paid by the shareholders. And the difference between the called up capital and paid up capital is called call-in arrears. The difference between called up and paid up capital is called call-in arrears. So these are the main kinds of share capital. Next is accounting for issue of shares. What are the accounting journal entries for the issue of shares? These are the 6 journal entries. The first one is on receipt of for issue of shares. For issue of shares, the first journal entry is on receipt of application money. Application money receipt ചെയ്യുമ്പോൾ entries ആണ് ഫസ്റ്റ് വരുന്നത്. That is bank account debtor to share application account. This is bank account debtor to share application account. The bank account it's actual amount received. So what are the actual amount received on application money? That is bank account debtor to share capital, sorry, to share application account. Next one is transfer of application money to share capital. The journal entry is share application account debtor to share capital account. For transfer of money to share capital account, it is share capital account debit and share application account debit and share capital account credit. And the third one is on share allotment due. So the journal is share allotment account debtor to share capital account. The fourth is share allotment money received. In the case of share allotment money received, so bank account debtor to share allotment account. And the fifth one is on share call due. So the entry is share call account debtor to share capital account. And the last share call amount received, then the entry will be bank account debtor to share call account. In the case of money received, so the debit is bank account and the credit is whatever account, that is share application account or share call account, etc. So you have to remember that in the case of application, on the case of receipt, always bank account will be debited. So first is on receipt of application money, the entry is bank account debtor to share application. In the case of transfer, it is share application account to share capital. An allotment, share allotment account debtor to share capital account. And the allotment money received, then bank account debtor to share allotment. Share call due, the share call account debtor to share capital account. And last is share call amount received, then bank account debtor to share call account. These are the 6 entries regarding the issue of shares. Next is in the case of shares issued at premium, then also another 6 entries, that is the case of shares issued at premium. So on receipt of application money, this is also the same entry, that is bank account debtor to share application account. The change is that in the case of issued at par, only application money will be included, but in the case of premium issued at premium, the application plus the premium amount is included in the bank account. Application and premium amount is included in the bank account. But in the case of issued at par, there is no such premium amount, only application amount. The next is transfer of application money to share capital account and securities premium account. The difference is in the case of transfer for premium account, it is transferred to share premium account. That is the difference. So share application account debtor to securities premium account to share capital account. And in the share allotment due, the same as earlier, share allotment account debtor to share capital account. And share allotment money also same, bank account debtor to share allotment account. Share call due also same, share call account debtor to share capital account. And the last, share call money received, bank account debtor to share call account. The difference is the first, in the case of first entry, that is premium amount should be added. And the second entry, the securities premium account also credited. So this is the difference between issued at par and premium. And the last is issued at discount. So here the journal entries share, all other journal entries are same as earlier. The difference is in the case of transfer, that is share allotment account debtor, discount on issue of shares account debtor to share capital account. In the case of premium account is the premium account is credited, but in the case of discount on issue of shares account is debited. So you have to calculate the total amount is due amount plus discount amount. In the case of premium, That's due amount plus premium amount. Here is due amount plus discount. The difference is that here the discount account is debited and the earlier class it is credited. So these are the main journal entries regarding the share issued par, premium and discount. Next is forfeiture of shares. What is forfeiture of shares? It is the cancellation of shares of a shareholder who fails to pay the amount due on allotment or any call within the specified time period. That is the cancel of shares of a shareholder. Due to this, they are failed to pay the amount within the specified time period is called forfeiture of shares. Here, the entry regarding the forfeiture of shares issued at cost, that is, share capital account debted to forfeited share account to share allotment account to share call account. This is the entry. Thus, you have to add the forfeiture share account debt. All others are same. Next is in the case of reissue of shares. Here, bank account debtor forfeited shares account debtor to share capital account. Here, bank actual amount received in the bank account and the forfeiture share account means loss on reissue. That amount is on debited in this forfeiture shares account and to share capital account. On transfer of profit on reissue, the entry is forfeited shares account debtor to capital reserve account because it is transferred to capital reserve account. These are the two entries. On reissue of shares, the entry is bank account debtor, forfeited shares account debtor to share capital, and on the transfer of profit on reissue, it is forfeited shares account debtor to capital reserve account. So the profit is transferred to capital reserve account. These are about the topics. Then we shall discuss about the previous year's questions. Questions of 2021. These are the some questions we will discuss. So this is about the accounting standard. The first question is the purpose of accounting standard is to. Anyone answer, please? ആർക്കെങ്കിലും അറിയാമെങ്കിൽ പറയാം കേട്ടോ. These types of questions are asked in your exam. So the first question is the purpose of accounting standard is to. First one, the option is increase comparability of reporting. Second is enhance reliability of reporting. Third is harmonize accounting policies. And the fourth one is all of the above.
All of the above.
Yes, correct answer. All of the above. അതായത് പർപ്പസ് ഓഫ് അക്കൗണ്ടിങ് സ്റ്റാൻഡേർഡ് എന്ന് പറയുന്നത് ഇത് മൊത്തമാണ്. എന്താണ്? ഇൻക്രീസിങ് കമ്പാരബിലിറ്റി ഓഫ് റിപ്പോർട്ടിംഗ്, എൻഹാൻസ് റിലയബിലിറ്റി ഓഫ് റിപ്പോർട്ടിംഗ്, harmonize accounting policies. So the answer is correct. Okay, good. The second one, conceptual framework for financial reporting under Indian accounting standards. The first option is it is an exposure draft issued by the ASB of ICAI in 2020 and it is a standard. And the third one is followed when it varies from the standard. And the last one is it is a substitute of the standards.
It's a standard.
No. Let's try. Anyone? Okay, I will tell that. Option A is the answer. It is an exposure draft issued by ASB of ICA in 2020. The third question. The Indian accounting standards are the standards prepared by the ASB in convergence with the IFRS, fully adopting IFRS, modifying IFRS in way compatible to conditions in India. Which of these statements are true? First, 1 and 2 only. Second, third only. C, second and fourth only. And the last is first, second and fourth only. ഏതായിരിക്കും ആൻസർ?
A.
എയോ? ഫസ്റ്റ് സെക്കൻഡ് മാത്രമേ വരുന്നുള്ളൂ? എനിവൺ? ഈസിയാണ്.
D ആണോ ടീച്ചർ?
ഓ കേട്ടില്ലേ?
D ആണോ ടീച്ചർ?
ഡി ആണ് ആൻസർ കേട്ടോ. അതായത് ഫസ്റ്റും സെക്കൻഡും ഫോർത്തും will include in it is prepared by the ASB in convergence with IFRS and modifying IFRS in way compatible to conditions in India. അതിൽ തേർഡ് വൺ ഇല്ല. അപ്പൊ എന്താണ് ആൻസർ? ഡി ആണ്. ഫസ്റ്റ്, സെക്കൻഡ് ആൻഡ് ഫോർത്ത്. The next question. Where is debenture redemption reserve transferred after the redemption of all debentures? Option A, capital reserve account, B, general reserve account, C, statement of profit and loss, and D, sinking fund account. Debenture redemption reserve transferred to
C.
C അല്ല. ആൻസർ ബി ആണ്, ജനറൽ റിസർവ് അക്കൗണ്ട്. Next is fifth question. When debentures are issued at par and are redeemable at a premium, the loss on such an issue is debited to profit and loss account, debenture application and allotment account, loss on issue of debentures account, premium on redemption account. When debentures are issued at par and are redeemable at premium, the loss on such an issue is debited to which account?
B.
No?
B.
B. No. Answer C. Loss on issue of debenture account. Answer is C. And the sixth question is Indian Accounting Standard compiled balance sheet. First is option A. Equity and liabilities come first and assets are reported below. The second option is assets come first and equities and liabilities are reported below. The third one is equities and liabilities are shown in the left and assets are shown in the right. And the D is all are permitted.
C.
C. No. B ആണ്. Assets come first and equities and liabilities are reported below. The next question is in Indian Accounting Standard compiled balance sheet. The first is proposed dividend is a current liability. Proposed dividend is shown under other equity. Proposed dividend is debited to P&L appropriation account, and the last is none of the above. Any answer? Answer D, none of the above. Next eighth question, that is for abnormal loss of stock. Option A, trading account is credited and P&L account is debited. B, trading account is debited and P&L account is credited. C, trading account is credited only. And the last is P&L account is debited only. Which option is correct?
D.
B അല്ല. D അല്ലേ?
D.
അല്ല. Answer option A ആണ്. Trading account is credited and P&L account is debited. The next question is, for transfer of goods from venturer M to co-venturer N, then the option A, joint venture with N account is debited in books of M. Joint venture with M account is credited in books of N. N account in books of M is credited. No entry is made.
C.
Oh,
C.
C ആണോ? ഓ കേട്ടില്ല.
C ആണോ ടീച്ചർ?
സിയോ? സി അല്ല, ഡി ആണ്. നോ എൻട്രി ഈസ് മെയ്ഡ്. So the 10th question is, memorandum joint venture account is opened under double entry system to find profit or loss in joint venture, to record remittance between ventures, to find amount due to or from co-ventures. Memorandum joint venture is account is opened to
B.
Okay, correct answer. Good. To find profit or loss in joint venture. Next is 11th question. Which of the following can be used for the purpose of creation of capital redemption reserve account? Profit and loss account, credit balance, unclaimed dividend account, securities premium account, and none of the above. Seven. Which answer is correct?
B.
Option A is correct. Profit and loss account, credit balance. And the next question is, which of the following can be utilized for redemption of preference shares? The first is the proceeds of fresh issue of equity shares, the proceeds of issues debentures, and the proceeds of sale of investment, all of the above. This question is easy. Which option is correct? Anyone?
D. All of the above.
No, that's wrong answer. Answer A is correct. The proceed of fresh issue of equity shares. These are the main questions included in the previous year's question paper. Okay. Thank you. This about the section. So we covered the topics: consignment, joint venture, insurance claim, the accounting for issue, reissue, and the redemption of shares. Some questions regarding the accounting standards, etc. These types of questions are asked in the exams. So, and problems are also included, but there is a time limit for that. So that is why problem is not included. These are the. Okay, thank you.
Yes, teacher. Thank you so much. There is a question in chat box by Karis. Is annual turnover and standard turnover are the same?
Okay. I can read this. Okay.
Is annual turnover and standard turnover are the same?
No, that is difference. That what is this? Can you see the slides? The annual turnover is the last 12 months immediately preceding to the date of fire. അതായത് ഡേറ്റ് ഓഫ് ഫയറിന് തൊട്ട് മുൻപുള്ള 12 മന്ത്സിനെയാണ് നമ്മൾ ആനുവൽ ടേൺ ഓവർ എന്ന് പറയുന്നത്. പക്ഷെ സ്റ്റാൻഡേർഡ് ടേൺ ഓവർ മീൻസ് ദ സെയിം പീരീഡ്, ഇൻഡെമിനിറ്റി പീരീഡിന്റെ സെയിം പീരീഡ് ആയിരിക്കും, പക്ഷേ അതിന്റെ പ്രിസീഡിങ് ഇയർ ആയിരിക്കും. ബോത്ത് ഓഫ് ദം ആർ ഡിഫറെന്റ്. മറ്റേന്ന് പറഞ്ഞാൽ 12 മന്ത്സ് ഇമ്മീഡിയറ്റ്ലി പ്രിസീഡിങ് ദ ഡേറ്റ് ഓഫ് ഫയർ. ദിസ് ഈസ് ദ പീരീഡ് കറസ്പോണ്ടിങ് വിത്ത് ദ ഇൻഡെമിനിറ്റി പീരീഡ്, ബട്ട് ദ ഇയർ, അതായത് ഡേറ്റ് സെയിം ആയിരിക്കും ഇൻഡെമിനിറ്റി പീരീഡിന്റെ, പക്ഷെ ഇയർ എന്ന് പറയുന്നത് പ്രിസീഡിങ് ഇയർ ആയിരിക്കും. സോ ബോത്ത് ഓഫ് ദീസ് ആർ ഡിഫറെന്റ്.
Ma'am, there is one more question. Can you please tell the answer of question number 8 of previous year question paper?
Okay. 8. 8. A. Option A. Any other queries?
1 and 2, please, by Karis. I think
Okay.
Karis
One.
needs the answer for 1 and
1 is D and 2 is A. Option A.
I think the participants need to read more in accountancy subject so that you will get the idea of how these answers are correct. Right, teacher?
Because this is an objective
Yeah.
question, so you have to read in detail.
Yes, the slides will be shared.
Okay, the previous year questions will also share. Yes.
We will share the previous year questions to you, or you can get the question paper from the official website of Indian Accounting Association. Just search for NATS by IAA. NATS means National Accounting Talent Search by IAA in Google. You will get the link to go to that website. Then you can download the question paper from there. Last 2-year question paper is available, or we will share that in our WhatsApp group.
Reshma, it's okay?
Yes, I think there are no other questions, ma'am. So can we conclude?
Okay.
Yeah, okay. So, dear all, so we have come to the end of this 2-day orientation program for National Accounting Talent Search Examination. This is organized by the Department of Commerce, University of Kerala, in association with the Kerala branch of Indian Accounting Association. And this program was arranged so that you get an awareness of this National Accounting Talent Search exam and also get an idea of how to prepare for this exam. And we hope that you have gained the knowledge for your preparation and you also got the confidence and inspiration to appear for this exam. So with that, we are also addressing 3 questions for your preparation. That is what to learn, where to learn, and how to learn. What to learn, we have already shared with you through these sessions that is conducted yesterday and today. And where to learn is something that you can choose. You can either go for your +1, +2 books, degree books, or you can download professional books from CA, CMA, ICMI website, or you can come visit our department library. We always welcome students of any programs. You can always come to our department library for more books. And also please note that the last date for registration is shown as 20 January, that is day after tomorrow. But don't think you get the entire day of 20 because the registration will be closed at midnight of 20. That essentially means you have the time till 11:59 p.m. tomorrow. So you have only time till 11:59 p.m. tomorrow. So don't waste your time. Just register. We will share the link to you, or you can just Google the link. You can type NATS by IAA. You will get the link. Okay, and yes, finally, I'm concluding the session by expressing sincere gratitude to our head of the Department of Commerce, University of Kerala, Professor Gabriel Simon Tattil, sir. He's also the Secretary of Kerala Branch Indian Accounting Association, also the Chief Editor of Indian Journal of Accounting, and is a former General Secretary of IIA. So on behalf of the Department of Commerce, University of Kerala, and the Indian Accounting Association of Kerala branch, and all the participants here. I sincerely express our gratitude and appreciation to Simon sir for conducting this two-day program and also taking a session on 17 January, that is yesterday. I also extend our gratitude to Dr. Ashwadinath and Dr. RDC, who are the assistant professors on contract of the Department of Commerce, University of Kerala, for taking today's session even with a short notice. So thank you so much, teachers. And finally, I thank all the participants for your cooperation. We wish you all the best for your exam, and we will be sharing all the recordings to you in the WhatsApp group along with the previous year question papers and registration links. So once again, thank you everyone and good night.
Thank you, Reshma.
Yes.
Thank you, ma'am.
Thank you,
Thank you, ma'am.
all.